Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We've had a lot of economic news lately, all pointing to an eventual interest rate cut, but with a big question mark over when that will be. Today, I wanted to look at what it means for equities. What's going to happen to the ASX200 for the rest of this year, particularly given how well it's gone so far, and what sectors to keep an eye on. Remember, this is general information only, and you should seek professional advice before making investment decisions. Matthew Kidman is the principal at Centennial Asset Management. Matthew, welcome back to Fear and Greed.
Hello, Sean. How are you?
Very well, thank you. Thank you for joining us. Tell me, let's start with the macro outlook. What's your take on interest rates? And then we'll marry that into what that means for the market.
So if we start in the US, where everyone follows that 10-year bond yield and what the Fed's doing, which sets rates around the world, as you know, at the start of the year, or even at the end of last calendar year, we were talking about interest rate cuts, maybe 5, 6, 7 of them starting in March. Well, we're in March, it's not happening. The economy's been too strong. It's been a surprise to everyone. We had the Fed the other day talking about still 3 rate cuts this year, maybe starting in the middle of the year to the back end. It feels to me that could be optimistic. 1 or 2 at the back end of the year. The US economy is still growing, something like 2.5%. That's on the kind of current indicators. And if you take it to Australia, we're kind of in the same position, that rate cuts, which would probably help some parts of the economy, probably not necessary at the moment because inflation hasn't quite come down. And so maybe the back end of the year, maybe not, maybe early next year. So I'm thinking flattish rates for the rest of most of this year.
With that as background, why has the market run so hard, and particularly Wall Street, but here locally as well? And actually, let's answer that one first. Why have we gone so hard?
Well, just like we said, the economy has been better than what anyone thought. And I'm not just talking about the Australian economy. I'm talking about the US economy, even the laggards in Europe and places, other developed countries, Japan. It's all been a lot better than what people thought maybe 6, definitely 12 months ago. And the US is leading the charge. So stronger economic growth. Sure, we've got higher interest rates, which is not great for equities because you use that discount rate at a higher level, brings back prices. But economies are better and profit growth is pretty good. Like we've just been through the earnings season here in Australia. We just finished a couple of weeks back. And on the broad spectrum of companies, not everyone was great, but generally it was slightly better and people came out of it optimistic. And as you know, what sentiment's like leads the charge.
It was interesting last week when the Reserve Bank just sort of came out and said we don't have a bias to hike rates anymore. The market from that moment took off. I think it jumped by more than 1%. One side says, well, the economy's slowing. That's not a good thing. The other side is exactly as you've explained. How does an analyst work out which way to go?
Well, it's interesting because the Australian economy and the Australian interest rate cycle is a bit behind the US. The US is already in that pause mode and we've just joined it. But we've finished at a lot higher rate. Now, what would derail markets? That's probably the question, and why sentiment is strong. What would derail markets is that economic growth remains strong and inflation starts to go up a little bit rather than down. Now, that would be terrible for markets. Rates would go up. So I think it's almost like, well, that's the bad scenario. The good scenario at the moment, economy reasonably strong, not too powerful, but reasonably strong, keeps people employed, keeps the economy ticking over and interest rates flat. That's enough for this rally to continue because the new bull market started in October 2022 in the US and it's going to last a while. There's a lot of momentum in the market. And as I said before, sentiment's strong.
Stay with me, Matthew. We'll be back in a minute. My guest this morning is Matthew Kidman, Principal at Centennial Asset Management. Okay, so let's go into sectors. I hate starting with the financials because you always laughed at me. Many years ago, Matthew and I worked together and I was a banking writer at the time and Matthew was just like the grand poobah guru of all markets. So you do refer to my knowledge in banks, which you overstate continually because I still can't understand them. What's going to happen with financials this year? The banks, particularly the Commonwealth Bank, they've done incredibly well.
I can never remember laughing at you at any stage, Sean. So let's get that clear. Look, I've been wrong on banks. Banks have, as you know, they've led this market, the Australian market, and they've done pretty well globally, actually. But the Australian market, the four big banks, have led the market, while the other, the barbell at the other end of the barbell, the iron ore plays, BHP, Rio, and Fortescue, have actually not performed that well in the new calendar year after doing well last year. So China's slowdown, that reflects a little bit in the iron ore place. But domestically, as I said before, interest rates have leveled out. The banks' margins have started to stop declining and just kind of, okay now. They're steadied. And that's been enough for people to get excited and say, okay, well, the outlook is probably better than what it was. Therefore, we're going to buy them. So, look, I always keep saying banks are expensive in Australia. They are. So it's hard to see them going up a lot, but the market's supportive of it, and the fundamentals, the margins, the top line growth is improving. So conditions are improving. Whether it can drive share prices a lot higher, I'm not sure, because they're expensive, but the conditions are better.
What about the retailers? And let's split it into staples, consumer staples, the big guys, the Woolies and Coles and that, and then the discretionary ones. And even that sector, we can split between the, Harvey Norms and JB Hi-Fis versus the Levises and online plays and stuff like that. Starting with the staples, what do you reckon of them?
Well, the staples normally get a lot of attention when things are slowing down, and they're staple for that reason. We've always got to go shopping, so they're defensive. And I think we're seeing an unwind of that at the moment. I mean, there's machinations in the food market. We've seen Aldi, which is not listed here, obviously the German company, winning market share. Woolworths struggling a little bit. We've had, obviously the changes in management announced. Coles doing okay, but that sector, that non-discretionary staple market, is probably not where you want to be when the economy might be hitting bottom and, the outlook over the next 2 years just to grow a bit quicker, because they're defensive. If we go to the discretionary part of the market, now nothing's cheap, because everyone did a little bit better in the reporting season than anyone thought. But as you mentioned a few names there, Lavisa, JB Hi-Fi, Nick Scali, broad range of products from apparel through to electronics and furniture. They're all doing okay. The top line's not racing away. I mean, Australians aren't shooting the lights out in terms of the economy, but they're getting really, really good deals out of China. So freight rates were extremely high during COVID. They've come down, and now they look like they're going to stay down for a while. But more importantly, there's excess capacity in China, because the Americans and the Europeans, but mainly the Americans, have departed, and everyone got a shock at how much margin these retailers were making on their products. So I think that's a good sign. I think that's going to continue. The Chinese are desperate for Australian business, even though we're nowhere near as large as the Americans. Any business is good business, and Australians have got the whip hand in that respect at the moment. So I think the outlook looks all right. Top line okay, demand okay, not running away, but not bad, but margins staying pretty strong.
I love the term industrials, Matthew, because it just captures all sorts of things, from the building materials companies, which seem to be continually under takeover offer now, through to all sorts of things. Let's start with building materials.
Well, there's not much left, is there? No. I don't think the Boral one will get up under the current prices, where you've got the Seven Group, which already owns most of Boral, wanting to take the rest out. Maybe that's the last kind of stock that stays there, because I don't think Kerry Stokes and Ryan Stokes will pay up too much. They'll get it on the cheap as they see it. CSR's gone, ABD, Adbri is gone. So there's not much to choose out of, which is a bit of a pity. There's things like Mars Group, which is a smaller play, GWA, which does bathrooms, toilets, that kind of stuff. But I think building materials, or a housing boom, is what will drive the next leg of Australian growth. It won't be this year. We all know housing's tough at the moment. It's expensive. But costs in general have come down. For example, talking to Brickworks, which is another player in that field, they were saying that bricklayers, the price for bricklayers has dropped from like $2.50 a brick to $1.40 in the last 6 months. So the labour pressure and the raw materials are coming down, and I think that will lead, over the goodness of time, especially if we get an interest rate cut at the back end of this year, start of next year, housing, because we've got a very tight housing market. We need houses, and with the fullness of time, we will get houses. So the margins are lining up and the demand's there. I think 25 into 26 could be really strong for that sector.
We're kind of running out of time, but I want to talk to you about the travel companies. We're jumping around a bit here, from Qantas through to some of the service providers. They ran hard. They've come off a bit. What do you think the outlook for them? is?
Yeah, I think it's mixed, exactly what you just said. I think leisure's okay. Corporate travel as a sector, not so good. It hasn't come back as strong. It's more competitive. Qantas, I think, is suffering now from where it was, from competition coming back in. We had that kerfuffle last year about Qatar, struggling there. But then again, you've got something like Webjet, which is mainly these days a wholesale into booking hotel rooms and accommodation. That's got a niche going really well. So it's really mixed. I think leisure will continue to go strong, which might be good for Flight Centre. I think corporate is going to struggle for a bit longer.
Okay, we can't wrap it up without asking for some sort of stock that you particularly like. Now, listeners, remember, always seek professional advice before going and making investment decisions. It's all about your personal circumstances, not what Matthew thinks. But having said that, Matthew, give me one.
Yeah, you're always, in my area of the field, you're always looking for small caps that no one knows about, under-owned, so you can get on board early. And one that I would say that has been a struggler for years, but might have found a nice little niche at the moment, is SKS Technologies. It used to be called Stokes. It's a company that provides electrical services, so your Sparkies at a corporate level. And never made a lot of money, but more recently has started to make a lot of money. And the niche they've found is wiring up data centers.
Oh, wow.
And that's a boom product at the moment. Used to be a couple of percent of the business. It's heading towards 20-25% of the business. Good margins, driving profit growth, capped at 40 million, really small. Could easily do some good work here.
SKS, is that it?
SKS Technologies. I don't know why they call it that when it's a Sparky company, but there you go.
SKS is Sparks or something like that. Matthew, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Matthew Kidman from Centennial Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.